Well, today may have been an ice patch for stock investors, but last year was a smooth ride. The S&P 500's 29% gain, for example, was 12 percentage points greater than the Europe 600 index's return. And for stocks that generated more than 90% of their sales here in the United States, the average gain was a whopping 33%. So will that trend continue in 2014, or should you broaden out globally, adding to your mix foreign shares or U.S. firms that do a lot of business overseas? Seema Modi takes a look.
They say home is where the heart is, but in 2013, home is where the money was. A third of all companies that made 90% or more of their sales in the U.S. beat the S&P 500, thanks to an improving economy and a stronger dollar. But this year, investors may be wise to expand their horizons. BofA Merrill Lynch equity strategist Savitha Subramaniam is advising clients to sell U.S.-centric stocks and to buy multinationals in 2014 because better than expected economic data is more likely to come from outside the U.S. in the coming year. Oppenheimer's chief market strategist John Stolfus says if you're going to take a global approach to investing in 2014, stick with consumer discretionary stocks.
Consumer discretionary because we're beginning to see around the world the development of a culture that mimics the U.S. consumer. And just as the consumers led the U.S. markets back, we would expect that will happen both in Europe as well as in Asia.
So which consumer-focused companies with global exposure look attractive? Oppenheimer says Nike, Mattel, Harley-Davidson, and Tiffany are some stocks to consider. But be forewarned, several experts caution that any type of distress, like political dysfunction or security concerns overseas, could send investors right back home. For Nightly Business Reports, I'm Seema Modi.